Meta could deliver quite impressive results since Mark Zuckerberg has announced the year 2023 as the year of efficiency, and the stock has returned almost 200% in 2023 alone. This year in February, the company announced the start of a quarterly dividend payment, and while this is good news for dividend investors, many also see this as a bad sign because they read this as an indication that the growth story of Meta might be over now. But is this really true? Or can Meta become the next favorite stock for dividend growth investors? If you want to know if you should add Meta to your portfolio, stay tuned, because in today's video I will dig into the business models and the markets of Meta, analyze the strategic position by doing a Porter's 5 forces analysis, and have a look at the latest financial statements to see how they are doing. I'll also check their valuation and do a discounted cash flow calculation to determine their fair value. In the end, we will see if Meta is a good long-term investment or not. My name is Florian, welcome to Cashflow Maniac. Meta has the ticker symbol of actually Meta, M-E-T-A, and they are listed on the Nasdaq. They're working in the communication service sector and were founded 2004. They have around 70,000 employees at the moment and their headquarters sits in Menlo Park, California. The market cap sits at $1.2 trillion right now. Meta is probably best known for their free social media platforms, Facebook and Instagram. And while Facebook helps to bring people together, build their own communities, share live moments, discuss what's happening, and discover and connect to interests, Instagram, with their Instagram feeds, stories, reels, videos, and shops, is actually a place where people and creators can express themselves, push culture forward through photos, videos, and private messaging, and connect with shops from their favorite businesses. But there are other brands that belong to the Meta Corporation, like the WhatsApp Messenger, which is a simple, reliable, and secure messaging application that people and businesses worldwide use to communicate privately. But there are also other brands like the Reality Labs and Oculus, where Meta actually focuses on AR and VR, content software, but also hardware with their Oculus headsets to bring people together in the metaverse and connect and share moments in a direct and meaningful way. But how does Meta actually earn money with all these services while the majority of them are actually free to use? To answer this question, we have to look at the last quarterly report. Here we see that from their total revenue in the last 12 months, the vast majority comes from advertising revenue. That is almost 98% of the total revenue. And even if Meta is not breaking down these numbers in detail, I think it's fair to assume that most of this revenue is actually generated by Facebook and Instagram. They also show a revenue of around $2 billion for their Reality Labs, but if we look down here at the operating income, we see that Reality Labs is actually in the red. So even though it is generating a little bit of revenue, the operation of their Reality Labs is not profitable at the moment. So to understand the business model of Meta, we should have a closer look at the business model of Facebook and to a certain degree also Instagram. And these platforms are essentially attention merchants. With their infinite scroll feed, Facebook is essentially providing an unlimited source of entertainment for their users and is trying to grab the attention of all their users for as long as possible. When they have this attention, they are also showing them targeted ads that are based on the user data and the interests of their users. And for these ads, Facebook is actually paid based on the impressions, likes, clicks, and shares of these ads. Meta is active all over the world, although their main business is still coming from the US and Canada. In 2023, around 46% of their revenue came from the US and Canada, while around 24% came from Europe, 90% from Asia Pacific, and around 11% from the rest of the world. So geography-wise, even though there is a concentration for the US and Canada, Meta is still quite diversified. With the amount of communication and user data that Meta is gathering with their various platforms, they are in a prime position to benefit from the AI trend by, first of all, leveraging this data to build their own AI models and products, and to integrate these models into their products and services. For example, we can see here their seamlessly communication translation model, where they have a family of AI translation models that, according to them, enables our natural and authentic communication across different languages. But they are also trying to integrate these AI models into their augmented reality and mixed reality products. With Llama, they are also providing an open source large language model platform that is free to use for all. And one thing that I'm especially excited about is the use of AI in their WhatsApp within WhatsApp Assistant. With Instagram, I think that Meta has already shown that they are very good at personalizing content based on the data, on the user data they have gathered. And when they continue this and combine it with WhatsApp, I think it will be a huge success. Here we can actually see a couple of examples of their Meta AI, which is already the first step to this assistant. And they show a couple of use cases down here, which range from simple answering some questions to exploration with Reels. So the AI assistant can also integrate Reels into the answers. They can generate pictures. And of course, it can also help you efficiently search the web. And they even bring different personalities to their AI. Like, for example, this dungeon master that eerily looks like Snoop Dogg. Recently, there has been a lot of noise around the ban of TikTok in the US. And while I don't want to go into too much details here, because nothing is decided yet, Meta could definitely be one of the biggest beneficiaries from this ban, if it really comes. But even if nothing happens, the noise that is currently generated around this ban and around TikTok might also push potential customers more to Meta, because they might perceive Meta as the better place for the advertisement money until this discussion is over. But even without the controversy around TikTok, Meta is operating in a market with a huge secular trend. The global CAGR of this digital advertising market until 2013 is expected to be higher than 15%. And with owning two of the biggest social media platforms that can benefit from this trend with Facebook and Instagram, Meta is definitely bound to benefit from this huge secular trend. Let's have a look at the strategic position and the mode of Meta by doing the Porter's 5 forces analysis. First, I estimate the threat of new entrants as low. Even though the switching costs for advertisers are basically non-existent, I still estimate the threat of new entrants as low, as the development of a successful social media site is not easy and comes with significant costs. This includes investments in technology and infrastructure, but also data analytics. The threat of substitutes I would rate as medium to high. Each social media platform offers unique features or services that makes it tough to be replaced directly. But where these social media platforms compete against each other is the time and attention of the users spent on their platform. So the emergence of new technologies could disrupt the social media industry and create substitutes for the traditional platforms. The competitive rivalry in the sector is very high. This is due to the high numbers and diversified offerings of social media platforms today. New players are constantly trying to enter this market, and with innovative services, they could steal away users from the established platforms. Although, with their strong position as one of the major social media sites, Meta definitely has some moat here. But this also puts pressure on the advertising pricing, which is the main source of revenue for Meta. So Meta has to constantly focus on building and securing their user base and also exploring new revenue streams. The bargaining power of their customers is also quite high. Users today have a wide range of options when it comes to social media platforms, and they can easily switch between them. The platform with the better and more interesting service will win in the end. So Meta and Facebook have to continually innovate and improve their user experience to stay relevant in this industry. The bargaining power of their suppliers, on the other hand, I would rate as quite low. As Meta develops their own infrastructure and technology, they don't have so many suppliers in the first place. In some areas, such as hardware components, they still rely on external suppliers, but as one of the largest players in the social media industry, they still have a significant bargaining power against these suppliers. So overall, I would say that Meta is operating in a highly competitive market, and even though they do have quite a strong position today, it is hard to say who will be the winner in this very quickly changing and very innovative industry 1 year from now. Before we jump into the financial analysis, if you do like the video so far, please smash the like and the subscribe button in order not to miss my next video. As I already mentioned in the intro, The growth of Meta over the last year has been very impressive. In the last 12 months alone, they could generate returns of 133% compared to the around 30% of the S&P 500. So they could beat the S&P 500 quite easily. Over the last 5 years, it looks similar. Here we also had a performance of around 190%, while the S&P 500 had a total return of around 100%. So again, easy outperformance. Over the last 10 years, this trend is even more significant. Here we have a performance of Meta of around 735% compared to the 250% of the S&P 500. But what we can also see here is that the volatility of Meta was actually quite high in the same time frame. The financials of the company show a very similar picture to the stock chart. Here we also have a very nice uptrend in most of these metrics. From total revenue generated, we can see a very stable, very nice uptrend, to net income generated, very stable, very nice uptrend. We only can see quite a dip in 2022 actually, but in 2023 the stock price made up for this again. The free cash flow and the operating cash flow has also very nice uptrend. Here we can also see the slight dip in 2022, but it's not as pronounced as in the net income. And with more than $70 billion last year, the cash flow generated is actually quite significant. The growth numbers of the last 5 years are also quite significant, with revenue growth of around 20% CAGR for the last 5 years, free cash flow growth of more than 25% on a 5-year basis, and net income growth of around 12% over the last 5 years. The margins over here are also on very high levels. The operating margin is sitting at 37%, net margin at 29%, and return of invested capital at 23%. In these numbers, we can see that it's fluctuating a little bit, and the trend over the last couple of years is actually going down. But since their announcement of their year of efficiency in 2022-2023, they could increase their margins again. The numbers in their balance sheet also look quite nice. Their EBITDA is increasing on roughly the same level as we saw with the net income and the revenue. And even though their liabilities and their debt is increasing on a year-to-year basis, their non-current liabilities as of today are sitting only at $44 billion, while their cash and cash equivalents are sitting at $42 billion. So the current long-term debt is almost 100% covered with their cash position. And the rest they can easily pay from the EBITDA. Because Meta only started paying dividends just now, we don't see any dividend payments reflected here. But over the last couple of years, we can see that Meta actually bought back shares on a regular basis and with a significant amount. So for the last 5 years, we had a share dilution of minus 1.6%. But while these numbers all look very nice, many investors are concerned that Facebook cannot keep up this huge growth over the next couple of years. But when we look a bit deeper into the forecast, we can actually see that the EPS numbers are expected to grow on a very similar level like we had in the last years, at least till 2027. For the revenue number, it's very similar. Here we can also see a growth of around 20% on a year-over-year basis until 2027. Of course, this is only the forecast, not the real numbers, but still, the trend looks to be intact. To better understand the forecast and the trend, let's also look at the last quarterly update, and because of the year of efficiency last year, let's start with looking at the expenses as a percentage of revenue. At first glance, the picture looks quite nice. Here we had a peak of the expenses in 2022, and since then they could lower it quite significantly. They could lower the expenses for the general and administrative stuff by half, the marketing and sales expenses by around 60%, the research and development by only a little bit, around 4 to 7%, and the cost of revenue they could also bring down by around 7%. While I usually don't like companies to cut expenses in the R&D department, in case of Meta it's a bit different. Because they put so much money into the development and R&D for the metaverse and their reality lab without much success. In this case, I actually think it's better if they start distributing their excess cash as a dividend instead of focusing on these unprofitable and very questionable R&D activities. One of the biggest key metrics for social media platforms is the daily active users and the monthly active users. Here we can see the daily active people, DAP, as Meta calls them, for their app family, which is mostly Instagram and Facebook. And we can also see that this number is going up steadily over the last quarters. We can also see that the percentage from daily active people to monthly active people is roughly staying the same over the same time frame. So that means that their users are very active on the website and most of them are actually logging in on a daily basis. For the monthly active people, the trend is the same. Here we can also see a very nice increase on a quarter-to-quarter basis without a single quarter of decline. And with almost 4 billion monthly active users, Facebook is already reaching around half of the global population. But not only the user count has gone up over the last quarters, they did also manage to increase their average revenue per person on their platform. Actually, since the first quarter in 2023, they could increase this by 25%. One thing that definitely helped them to improve this is the integration of AI into their analytics tools. Basically, they are using AI to better reach the target audience of their advertisement partners. And I don't think they will stop here. I think with the further integration of these AI tools, they will be able to further improve this. There is one thing that I don't like at all about the Meta financials, and that is actually the amount of stock-based compensation that they pay. If you compare here the stock-based compensation against their levered free cash flow, we can see that the stock-based compensation makes up almost 50% of their levered free cash flow, which is an insane number. Also, the stock-based compensation has gone up at the same speed as their free cash flow, and unfortunately, I don't see any signs as of right now that this trend is slowing down. And even though I think that with their huge free cash flow and their free cash flow growth, Meta can actually afford this amount of stock-based compensation, this is still a trend that I don't like to see with the companies that I invest in. I think a far better use of cash than a huge amount of stock-based compensation or senseless R&D is to reward the shareholders by paying a dividend. So I definitely do like it that Meta is actually going in this direction now. And while the dividend yield of Meta is still very low, if you look at the dividend safety, we can also see that the payout ratio from revenue is only 3% and the payout ratio from cash in the trailing 12 months actually is only around 2%. So there is still a lot of room to grow this dividend. But of course, we need to see how Meta will handle this in the future. So before we sum this up and come to our conclusion, let's also have a look at the valuation and the discounted cash flow calculation to see where the valuation of Meta is currently standing. And when we look at the multiples, EV to EBITDA, PE and price to cash flow over the last 10 years here, all these numbers are not on the cheap side. And a couple of years ago, the multiples and the valuation of Meta was actually quite a bit higher than what we see today. For my fair value calculation, I assumed a free cash flow growth rate of around 15% and a net income growth rate of 12%. These numbers are actually quite a bit lower than the CAGRs that we had over the last 5 years, but I would not expect that Facebook can continue this insane growth that they had also into the future. So I would rather estimate these values a little bit more conservative here. With these numbers, I come to an average fair value of around $550. And by including my margin of safety of 20%, we come to a fair value of around $440. So the current stock price of around $500 sits a bit below my initial calculation, but quite a bit above my calculation when including the fair value. As multiples for price to free cash flow and the PE values, I actually did use the historical 5-year average values here. For the Gordon growth model, I actually took another approach and I did very roughly reverse engineer the necessary dividend growth rate to come to the rough fair value that we have as of today. And in this case, Meta would need at least a dividend growth rate of around 7.5%, even a little bit higher than this, in order to be fairly valued with the Gordon growth model. because we don't have any historical data here. We actually need to see what happens here in the future. But according to my calculation at least, Meta seems to be around fairly valued at the moment. Over the last 2 decades, Meta showed some impressive growth from a pure social media platform to a tech powerhouse and one of the biggest players in the digital advertisement market. Their financials do look good, with a great growth in the top as well as in the bottom line, and after accounting for the cash, basically zero debt. During their year of efficiency in 2023, they did cut their expenses very fast, and we can instantly see this reflected in the increase of their margins, even if these were already on a very high level. Unfortunately, their investments in AR and VR do not pay any returns as of today, and their Reality Labs business is still in the red. It needs to be seen if this strategy works in the end or not, but right now it is still a money pit. Recently, they have shifted their efforts more in the direction of AI, as this promises quicker returns, and it also fits very nicely into their overall strategy. From my point of view, there are more synergies for this to enhance their current products. From the virtual assistants for WhatsApp, over the open source large language model Llama, to improved analytics for better audience targeting for their advertisement business. The valuation and the fair value of Meta also looks quite reasonable right now and still leaves some room to grow. On the other hand, there are still some risks that can impact the business and the stock of Meta. The social media platform market is a very competitive one, and as one of the biggest players, Meta has to keep innovating to defend their position. The AI regulations that are in discussion in Europe right now and the TikTok ban in the US could also have a bigger long-term impact on their business to both sides. I do believe that the growth story for Meta is far from over, and even if their dividend yield right now is quite low, their payout ratios too. And with the insane free cash flow generation, their growth and their nice cash position, I do believe that they still have a lot of room for future dividend growth. So I am personally invested in Meta, although with a smaller position. But please, before investing, do your own research and only use this video as a starting point for your own analysis. This is my opinion based on my research, and I also don't know your investment strategy. That being said, thank you so much for watching, guys. If you did find the analysis helpful, please smash the like button and subscribe to the channel in order not to miss my next video. And if you're looking for another company that might also be a good fit for your long-term portfolio, you might be interested in this video.